Everybody, listen, we all want the same thing. We want the best, the best, the best. We want the best market, we want the best property, we want the best Airbnb. And that's the number one question I'm always getting. Hey, what's the best Airbnb or what's the best market, especially when it comes to Michigan properties to start with, right? The truth is, objectively, there is no best because it still comes down to how you design it, how you manage it, how much you buy it for, and what type of financing did you use to buy it? Because what is best is not necessarily going to apply to you. And the truth is, it probably won't. And let me guess, a lot of you have probably gone through the idea of, I'm waiting for the best opportunity. I'm waiting for a great deal. More times than not, all you guys use that as an excuse to not start. And because you use that as an excuse to not start, I'm gonna bet you haven't, or you haven't gotten to your second. So what we gotta do now is figure out what's best for right now. What's best for you right now? And the best way to figure that out is to start by identifying what your actual capacities are. How much property can you afford? How much capital do you have for furnishing? How much experience do you have for managing? What is your tolerance for managing properties? Do you intend to hire out your design, find people locally to property manage? How good are you finding local handymen? Are you adding amenities? Do you know how to add amenities? You see, there's such a gap in education and experience. And that's why, even if I told you, hey, this property is the best, it's the highest cash flowing property you can buy and the highest cash on cash return available, doesn't mean you would know what to do with it. So that's why we have to identify what's best for you and then go from there. So going back to it, if you've been asking yourself, what is the best property and market to buy in? The real question you should be answering is, what's the best property for you to start with? This video is a self-assessment for you to figure out what's gonna work best for you and your investment style. All right. One of the easiest things to start narrowing in on is what can I afford, right? This is primarily dependent on what your cash position is. Secondly, it's dependent on your credit score, which will help you determine what your mortgageability is. And what does mortgageability mean? That means your ability to get a mortgage and finance the property. Maybe some of you are very cash heavy and the mortgage is not a factor and you just need to be focused on your cash position. Excellent, great work on that regard. But I would still recommend you get the mortgage. Why? Because of all the investment assets out there, real estate is the only one that is easily leverageable and also a tax write-off once you get the mortgage. From all of these calls, I get a lot of people, typically couples or very ambitious single entrepreneurs. And typically what I see with their combined gross income is $150,000 to $300,000. Yes, there's a lot of people out there making some pretty good money, but you know what the truth is? A lot of them that are especially making $250,000 to $300,000 are spending $60,000 to $80,000 in taxes. And you know what they need more than anything? They need a break. What kind of break? A tax break. So typically when somebody is asking me what they can afford, they're usually asking about their primary ownership purchase. And I will tell them, on average, I see 2 to 3 times what their annual gross income is. But here's the difference. When you're buying an investment property, you're typically buying it and you're going to get the debt service covered, which is the mortgage payment, by the income. The income will actually offset what that cost is. And that difference will be what your profit margin is. So in all actuality, what can you afford? You can afford whatever profit margin you deem is viable versus what the holding cost of the investment is going to be. For instance, let's say the mortgage payment is $2,000, and between the mortgage payment and all the other utilities and landscaping, let's say you're at $2,700 in monthly cost to own and manage your property. The number one thing that determines your affordability to afford an investment property is your current cash position. Why? Why does it matter if it's a $2,000 mortgage payment or a $10,000 mortgage payment? Because when you're picking the right investment property, you're picking it based on what its gross income will actually be. For instance, you will never pick a property that grosses $10,000 and costs $12,000 to run. You'd be running at a deficit. That's not an investment property, that's a liability. Now, if you pick a property that grosses $5,000 a month and your all-in cost to run it every month are under $3,000, that means you're netting over $2,000 per month. Now, that's the kind of property I would always recommend you buy. What's the next equation you want to consider when you're trying to buy this property in terms of what you will call affordable? It's called the cash on cash metric. This metric simply measures how much cash you put in versus what kind of income you're getting out, right? So let's say you get this property that we just mentioned where you're making $2,000 per month. Let's multiply that by 12. Now you're at $24,000 of net income per year. Now, let's say that your all-in cost for the down payment as well as the furnishing cost added up to $100,000. What does that mean your cash on cash return is? 24%. It's just 24 over 100. What does that mean? It means for every dollar you put into this property, you're making 24 cents on it. But because you put so much money into it, 100,000, you're making $24,000 a year. So while it doesn't seem fast and easy to jump into this, if you had 4 of those, most of you are going to be making over $100,000 a year. At that point, you can see how 4 Airbnbs especially can really change your whole game. So when I started investing, I started with long-term rentals. And at that time, I just thought, can I make $200 to $600 per month of net income on each rental? And I thought that would be great. And I got excited. I said, if I can get it to an average of $500 per month, if I get to 10, I'll make $5,000 a month. I was so excited. I slowly started building. And you know what? It took a long time. But one day I discovered this thing called Airbnb. And some friends said, hey man, I think you should try it. I bet you'd be good at it. So then I took one of my properties that was making a little less than I wanted. It was making almost $200 a month, which really wasn't enough. One bad expense. And you know what I made that year? Negative. If I have one roof, let's say it's a $5,000 roof and you only made $200 per month, you would be at a complete loss at that point. So when I saw the Airbnb method, I decided to switch my long-term property into a short-term rental property. My hope was it would make at least double what I was making, probably $600 to $700 net per month. What I ended up finding after putting about $12,000 in furnishing into it was making almost $1,000 per month. Compared to what my long-term rental income was, that was over 3x of the net income. Of course, I had the upfront investment of the extra furnishing and design costs. Even with that considered, my number one goal was what? Create more cash flow every month. At that point that I realized it's time to continue to grow in the scale and get better and better with each investment after this one. And that's exactly what I did. So at that time, to me, it was just about increasing net cash flow, right? But now I realize, especially after that $12,000 in furnishing costs, there's something called the cash on cash metric that you need to be aware of. How much cash did you put in to get it out, right? Let's say I spent $100,000 on a property and all I was getting was $1,000 a month. Is that really worth it? Not really. So you need to figure out what your cash on cash metric needs to be. For me, I always target anything above 25% cash on cash. For every dollar I put in, I want at least 25 cents. So if I put in $10,000 on a property, I want to make at least 2,500. 100,000, 25,000 net per year. And again, these numbers are always looked at based on how much money you put in throughout the year. So now we're going to focus on strategy. We already covered the fact that long-term rentals don't make the highest net. And honestly, with the higher interest rates and higher purchase prices, it becomes less and less desirable as an asset class. Now we're going to focus on the furnished rental, which can be midterm or short-term rental properties. The biggest difference between short-term and midterm rental plays is short-term plays are typically under 30 days rented at any given time. Midterm rentals can be 30 days plus. It could be 6 months, 9 months, maybe even 12 months. Of course, at 12 months or more, you're looking at long-term, but this is still a furnished focus is what we're going to be talking about. Now, ideally, with the major difference between short-term and long-term being the length of time somebody rents it and what else, furnishing and decor being a factor, right? So you have a higher expense to get the property started, but you're trying to get a higher occupancy of multiple people versus one person renting it for a straight period. That's the biggest difference between long-term, short-term, and midterm. Truth is, short-term and midterm rental plays are very, very similar. And if you're doing one, you're probably going to end up doing both because they're on the same wavelength. They're typically both furnished stays. And the truth is, sometimes you have somebody come in that's coming in for a short-term stay. And after a while, they may become a repeat guest that end up wanting to stay for 30 to 60 days. I've had that. I don't even know how many times. On the other side, I've had some midterm stays that come in for 1 to 3 months. They might come back later on and say, hey, I'm going to be in town again. I'd love to stay with you for a few weeks. And I say, good, we actually have an opening. Here you go. See you soon. And we'll be glad to have you back. Many people are so used to investing in vacation-based destinations, but the truth is there's a lot of opportunity in inner city markets, very dense areas, and sometimes even the suburban areas, the secondary and tertiary markets. I know it sounds crazy, but the truth is it's absolutely a viable option. There are huge benefits to being oceanfront, lakefront, or near snowboarding and ski resorts. But beyond that, there's huge advantages to being close to airports, hospitals, great school systems, and other high net worth, dense city populations. Why? I've had 3 instances already where somebody has stayed with us for almost a year total while they are doing an addition or building a brand new house. And at those rates, sometimes that's actually boosting our cash on cash as high as 40 to 50%, which is absolutely fantastic. So when all these people call me and go, hey, I want to buy a property, they're typically focused on finding lakefront. And some of them already have short-term rentals. Maybe they're near Disney in Orlando. Maybe they're in Phoenix, Arizona, or some really well-known area like the Ozarks. But for me, what's actually done better than anything is investing in the dense areas. And I do the burst strategy whenever possible, which is buy, rehab, rent, and refi. The difference is I do short-term rentals, so I call them a burster strategy, STR, instead of just regular rent, right? And because the burster strategy has become my favorite type of investment to invest in, it also provides me with other exit strategies that many don't get access to. For instance, if you're in lakefront or beachfront, you're likely in a very seasonal situation where if you were not doing as well, especially in the down season market, if you had to sell, you might even be selling at a loss. The best time to sell those properties is in high season, right? But it's hard to want to sell in high season because you're usually making the most money in high season. So for me, because I'm in more densely populated areas, the highs and lows are a lot more mild when you're in a densely populated area. Plus, if you need to sell it, it's pretty easy because effectively it becomes a flip. You still have plenty of equity that you were able to build in because you did a heavy rehab on it. And if those regulations change enough to hurt or make you want to no longer be in that market, what you get to do is you get to go, hey, I'm just going to stop taking reservations. And what happens after your next weekend stay is already completed? Your cleaners are already on the schedule to go in there and clean it up. And guess what? Because you had such a nice property set up as a short-term rental, you already have amazing listing photos ready to go. So then you just contact your local realtor. You go, hey, can you throw this on the MLS for me? And boom, before you know it, you'll get a highest and best set of offers because the supply of really attractive homes is so low right now. So literally, you're creating a well-hedged position so that no matter what happens with regulation changes, you're creating a high cash flow product with great tax benefits. And simultaneously, if you need to sell it, you can. You get to sell it at a profit. Listen, I really hope that helped. And if that was helpful to you, if you understood cash on cash a little bit better, if you understand how to pick your market, if you understand that the best is really what's best for you, and if you understand that there are more markets than vacation markets available that are still very viable and profitable, then awesome. I'm so glad we could help you. Go ahead and write in the comments if you have any questions. If you're ready to get some coaching, check my link in bio and you can go ahead and apply for my STR Legend course. If you're looking to get more information about all of this, especially in the short-term and mid-term rental segments, check the link in description. It'll give you access to my free mini course and I hope you get a chance to check it out. I'm sure you'll enjoy it. Again, my name is Matt. If you like this video and you want to see some more, it would be awesome if you gave me a like and subscribe. So if you want to connect with me on Instagram or TikTok, it's in my link below. Looking forward to chatting with you in the future.